Do you see the same types of fraud among different companies, among different industries, among publicly traded and private companies? Um, or, or does the fraud vary in every case? Is it always unique, or are there lots of similarities? And what are the similarities? What are the differences from industry to industry and from public companies to private companies?
Wow, do you have 3 hours for this? There's there are different acts depending on what the company does. If the company is a manufacturer, there are certain acts of fraud that would apply more to a manufacturing operation, especially two sets of books, where you are buying various components, putting them together, and selling a full component. I can promise you that there are very few accountants anywhere who can actually put together all the pieces and say, "Oh yeah, that's exactly how many of these they needed, how many of that they needed," depending on the company. If it's a retail operation, they will play with inventory. They may juggle dollars. They may increase the look of sales. They may reduce the dollars worth of sales by not declaring some of the sales. As we're moving farther away from a cash from a cash economy, that scheme is getting more and more difficult because there's less and less currency actually being spent. If they're a service-oriented organization, whether they're a plumber or a plumbing operation, or they're an accounting firm, which is a service-based company, there are schemes used to have private companies, private clients, private customers. There are doctors who have been known to see patients, get cash, and not declare anything. However, in all of those situations, there is always the risk that something, somewhere, sometime may go wrong. For example, a doctor or an accountant who didn't happen to declare their small clients may suddenly find out that their client was gone after by a tax agent, tax authority, and they're going to call on the accountant, and they're going to say, how much were you paid, etc. Start looking at it and realize the accountant didn't declare the income, which could be very embarrassing, and also it's illegal. In the case of sales, two sets of books in a manufacturing operation, which I've seen many, many times, and I've become very adept at being able to actually track it, not by the books, but by the actual activities of the company. They will mistake. See, these people are not really experts in books and juggling numbers. They're really good at lying, cheating, and stealing, but they don't tell you that. And I will discover that there's a mismatch between what goes in and what comes out based on the entire operation. So there are ways to handle that. When it comes to retail, they can, like I said, not declare sales. They can have even locations that aren't really on the books. It's very interesting. But each of these leaves some kind of a mark somewhere that if you look at the books, you're never going to find it. When I look at the company as a whole, it's surprising how many trails are left there, even if they're not on the books. So there are different schemes that work for different kinds of companies, and in many ways, they actually, over the long term, is where they cause problems. In the short run, the senior people, the trusted people, the owners, they're going to get away with it. It's the longer term where it starts to ensnare them in other issues, and they may find out that opportunities for growth or loans or investments aren't there because their performance isn't there, even though, in fact, their performance is there, but they've just hidden a lot of it.
To completely unravel fraud, to discover it, to figure it out, needs an outside specialist, someone like you, right? It's not something. It's sort of a warning. Don't do this at home. Leave this for a professional. But there must be some sort of warning sign that most people could see and would set off the alarm bells and say, "Hey, let's call Alex. Let's figure this out. Let's see if there's something there. If there's smoke, there's fire. what's the smoke that someone should be looking for?
It depends on who's doing the looking. It has to be someone with a financial interest in the company where they're going to be getting paid from the operations of the company. And that's why I say it's accountants generally, if they would prefer not to find it. And I'm sure they'd be very upset if hearing me say this, but having worked in it for almost 10 years and in public accounting on its own, the accountants used to be happy to say, we've been doing it this way for 20 years and we're not going to change. The fact that they were missing things, they didn't seem to care. They were, as long as they were fulfilling the requirements of the accounting boards, they were happy. And I discovered from being reprimanded in the first accounting firm where I mentioned this, I realized that a fee-paying client is far more important to that firm than a salary-drawing staff. And they didn't want to really see what was going on as long as the client was functioning and paying the bill. The issues really come down to who's going to blow the whistle, who's going to get suspicious. Well, they have to, first of all, be in a position to take action. If they're a supplier getting paid and their terms are suddenly getting stretched out, they would become concerned. Do they have a right to check the company? Not at all. If it's a very minor investor who has a small amount of money but they rely on it, they may not have any right at all, but if they begin to notice something is wrong, they may become very concerned. And having the ability to send someone in and also the funds to pay that person, there has to be a fair amount of money at stake to be willing to go forward. I had a case a few years ago of a sale leaseback on about 6 properties for a manufacturer. A sale leaseback means that this company owned all these various small factory buildings, and they sold them to one investor who bought the buildings, paid them for the buildings, but they would now pay rent to that investor. And for tax purposes, it really isn't treated as a sale, but that's a minor issue. So they got a lot of working capital out of those buildings, and they stayed in business. What they began to notice, these investors, was that the company claimed to be losing sales, it was in trouble, and they started actually emptying some of these buildings and not paying the rent, which of course they owed. And the owners kept apparently talking to each other with nobody else. And by the time they came to me, they were down from 5 buildings being owned or being used and rented down to 1. It was the big one, but it was only 1. And they said, well, what should we do? Should we evict them? Should we do this? Should we? And they had no idea what to do. All they did was talk to each other. And I went through some of the books, and I realized that as the company was either losing sales, the owner of the company had far more interesting financial aspects or outlets in investing money in venture capital deals, which was making a lot more money than this manufacturing company. And the salary that was being drawn by that person was the same salary when they had a much bigger company. Now, when the company slows down, they have to not draw quite as much salary, but you can't control that. So by the time they got to me, I realized that he was in fact slowly killing the company, and he was going to leave them with a bunch of empty buildings. And if you kill the company slowly like that, there may be nothing left to go after, because if you're only secured by the buildings or by the operation of the company, and the company disappears, you're back to owning now 5 empty buildings. And I looked at it and I realized he was slowly killing the company. I did some searches. I do use private investigators from time to time. And they found a whole lot of business interests he had that were never disclosed. Was he required to disclose them? I don't know. But the fact is, he had far more interest in it, and it turned out he had inherited the company from his father. Father loved the business. He didn't. So he slowly was draining it down, and they didn't know if they should sue. They didn't know which end to go with. But I finally said to them, as he claimed he wasn't making any money, well, if you're not making any money out of it, are you going to stay in business? The logical answer would be, no. Why are you going to work for nothing? So it came down to probably the shortest report I ever wrote. I said, file for an eviction notice, because he's not paying the rent. file it for immediate eviction. If he accepts it, then you know you've saved a lot of time knowing that he's cheating you. But if he fights it, I can promise you he's making money that you don't know about. Now, what they did with my recommendation, I don't know. They kept that between the two of them. Or there actually was, I think it was about 7 or 8 of them. It was a big group. But it came down to he was openly cheating them. But whether or not they did anything, I don't know. They were having a hard time renting the other 4 buildings. So they're all different situations that come up. And it doesn't necessarily mean that the investor, the claim holder, the ex-spouse who may have a financial claim for community property, it doesn't mean they're necessarily going to have an ability to take any action to help themselves. And that's sometimes when you get whistleblowers who will contact tax departments and others and try to get them in trouble that way. I hope that helps you.